Welcome back to Boni's Life, where we decode the crypto markets with intelligence, insight, and just enough wit to keep you awake during those late night trading sessions. I'm Boni, and if you're wondering why Bitcoin is playing hard to get at $107,000 despite institutions throwing money at it like it's going out of style, you've come to the right place. Today is July 2nd, 2025, and we're diving deep into what I call the great Bitcoin paradox of our time. We've got institutional demand that would make a gold rush look like a garage sale, yet Bitcoin is sitting there like a teenager who just got asked to clean their room. Technically responsive, but not exactly enthusiastic about it. Let me paint you the picture that's got every trader scratching their heads. Bitcoin spot ETFs have pulled in $48.6 billion since launch. That's not a typo, folks. That's 48 billion with a B. BlackRock alone hoovered up $3.85 billion worth of Bitcoin just in June. Yet here we are, with Bitcoin doing its best impression of a sideways escalator. Tom Lee from Fundstrat, who's forgotten more about markets than most of us will ever know, dropped some wisdom that explains this puzzle. He pointed out that some of these ETF inflows might be what he calls wash transactions, essentially people moving their existing Bitcoin from cold storage into ETF wrappers. It's like rearranging deck chairs on the Titanic, except the Titanic is actually doing just fine. Thank you very much. But here's where it gets interesting. And by interesting, I mean the kind of interesting that makes you question everything you thought you knew about supply and demand. Leo also highlighted that early Bitcoin adopters, the ones who bought at prices that would make your morning coffee look expensive, are sitting on profits so massive they could probably buy a small country. And guess what? They don't care if Bitcoin hits $1 million. They're sellers at 100,000. Think about it. If you bought Bitcoin at $500, selling at 100,000 represents a 20,000% return. At that point, you're not trading. You're basically printing money with a side of smugness. These early adopters are creating a ceiling of selling pressure that's neutralizing all that institutional buying pressure. It's like trying to fill a bathtub with the drain wide open. Now let's talk about the global events that have been shaping our crypto landscape over the past 24 hours. Because if you think crypto trades in a vacuum, I've got a bridge to sell you. And it's probably tokenized. First up, Connecticut decided to join the "We're Scared of Bitcoin" club by officially banning state and municipal investments in Bitcoin. Governor Ned Lamont signed House Bill 7082 into law, effectively telling Bitcoin, thanks, but no thanks. It's like watching someone refuse a life jacket on a sinking ship because they're worried it might get wet. Meanwhile, Arizona's Governor Katie Hobbs vetoed a Bitcoin reserve bill for the third time. At this point, it's less about policy and more about personal vendetta. I'm starting to think Bitcoin owes her money or something. But here's the kicker that actually matters for your trading strategy. The SEC is reportedly considering a simplified approval process for crypto ETFs instead of the current bureaucratic maze that makes filing taxes look like a fun weekend activity. They're proposing a 75-day automatic approval system. If the SEC doesn't object within that time frame, boom, you've got yourself an ETF. This could be the catalyst that triggers what we call alt season, that magical time when alternative cryptocurrencies go absolutely bonkers, while Bitcoin sits there looking dignified. It's like watching the quiet kid in class suddenly become the life of the party. Speaking of institutional adoption, Deutsche Bank, yes, the same Deutsche Bank that's been around since before your great-grandfather was born, is planning to launch crypto custody services in 2026. When a bank that's older than most countries decides crypto is worth their time, you know we're not in Kansas anymore. The institutional adoption story gets even more fascinating when you look at the numbers. Corporate treasuries bought 2.1 Bitcoin for every single coin that ETFs absorbed in the first half of 2025. That's not just adoption, that's aggressive accumulation. These companies aren't dipping their toes in the water, they're doing cannonballs into the deep end. Now let's get into the technical analysis that's going to guide our trading strategy for the next 24 hours. And before you ask, yes, I know technical analysis sometimes feels like reading tea leaves, but at least tea leaves don't have 24-hour trading volumes. Bitcoin is currently trading within what technical analysts call a descending channel. Rect Capital, who's built a reputation for calling market moves with surgical precision, noted that Bitcoin was breaking out of a multi-week downtrend that started in mid-May. The key word here is was, because as of today, we're seeing what looks like a post-breakout retest. Here are the levels that matter for your trading decisions. Support is sitting pretty at the $100,000 to $102,000 zone. This isn't just a number I pulled out of thin air. It's where institutional buyers have consistently stepped in and where early adopters seem to pause their selling sprees. Resistance is currently at $107,500 to $108,000. This is where Bitcoin has been bumping its head like a tall person in a low-ceiling basement. Break above this level with conviction, and we could see a rapid move toward $130,000 to $140,000. But here's where things get spicy. And by spicy, I mean the kind of spicy that makes you question your life choices. The CME futures premium has dropped to 4.3%, the lowest since October 2023. Marcus Thailand from 10x Research pointed out that this suggests waning institutional appetite. It's like watching the enthusiasm drain out of a room when someone mentions doing taxes. Adding to the bearish cocktail, funding rates have flipped negative, which means perpetual futures are trading at a discount to spot prices. In plain English, this suggests that traders are more interested in shorting than going long. It's the market's way of saying, we're not feeling it right now. Let's not forget about Ethereum, which is doing its own dance around $2,446. ETH has been consolidating in the $2,400 to $2,500 range, and frankly, it's been about as exciting as watching paint dry in slow motion. The altcoin market is showing mixed signals that would confuse a GPS. XRP is down nearly 1% despite its phenomenal 365% year-over-year performance. Solana is barely moving, BNB is up slightly, and the rest of the market looks like it's waiting for someone else to make the first move. Now, here's your 24-hour trading strategy. And I want you to pay attention because this is where we separate the wheat from the chaff, the signal from the noise, and the profitable trades from the expensive lessons. For long positions, you're looking for a decisive break above $108,000 with volume. Not just any break, we need volume that suggests institutions are stepping back in. Your entry should be on a retest of $108,000 as support, with a stop loss at $105,500. Target the $112,000 to $115,000 range for your first profit-taking level. For short positions, a break below $105,000 opens the door to the $100,000 to $102,000 support zone. Your entry should be on a retest of $105,000 as resistance, with a stop loss at $107,000. Target $98,000 to $100,000 for your profit-taking zone. Risk management is not optional. It's like wearing a seatbelt while driving. You might feel invincible without it, but physics doesn't care about your confidence. Keep your position sizes reasonable. Use stop losses religiously. And remember that the market can stay irrational longer than you can stay solvent. The sentiment indicators are painting a picture that's more complex than a Christopher Nolan movie. We've got institutional demand that's undeniably strong, but we also have early adopter selling pressure and technical indicators that are flashing yellow rather than green. Volatility has been compressing, which historically precedes significant moves in either direction. It's like watching a spring get wound tighter and tighter. Eventually, something's got to give. The question isn't if we'll see a big move, but when and in which direction. The macro environment is adding another layer of complexity. We've got the Federal Reserve making noises about monetary policy, trade tensions that could affect risk appetite, and geopolitical events that make crypto look like a safe haven one day and a speculative risk the next. Don't sleep on the stablecoin market, which has been showing interesting dynamics. Fed Chair Powell recently told the Senate that the stablecoin industry has matured, which is central bank speak for, we're not going to regulate this into oblivion. That's actually bullish for the broader crypto ecosystem. Before we wrap up the analysis, let's talk about security, because losing money to hackers is like getting robbed by someone you invited into your house. Slow Mist's Q2 report highlighted 5 emerging attack methods that are becoming more psychologically sophisticated. We're seeing a shift from purely technical attacks to social engineering that would make a con artist proud. Be especially careful with browser extensions, hardware wallet tampering, and social media scams. The attackers aren't getting more technically advanced, but they're getting better at manipulating human psychology. It's like they've been taking courses in behavioral economics with a minor in criminal intent. So what's the 24-hour outlook? We're in a consolidation phase that could break either way, but the probabilities are starting to favor the bulls if we can get above $108,000 with conviction. The institutional demand story remains intact, even if it's being temporarily masked by early adopter profit taking. Your key levels to watch: $108,000 for bullish breakout, $105,000 for bearish breakdown, and $100,000 to $102,000 as the ultimate support zone that determines whether we're still in a bull market or heading for something more concerning. Remember, successful trading isn't about being right all the time. It's about being right more often than you're wrong, and managing your risk when you're wrong. Cut your losses quickly, let your winners run, and never risk more than you can afford to lose. That last part isn't just trading advice, it's life advice. The expert consensus is pointing toward higher prices in the medium term, with targets ranging from $130,000 to $200,000 by the end of 2025. But remember, predictions are like weather forecasts, useful for planning, but don't bet your house on them. That's a wrap on today's analysis. And if you found this valuable, smash that like button like it owes you money, subscribe for more market insights that actually matter, and ring that notification bell, because the crypto market doesn't sleep, and neither should your education. Follow me on all the social platforms for real-time updates, and remember, in crypto, the only constant is change, and the only certainty is uncertainty. But with the right analysis, proper risk management, and just enough skepticism to keep you honest, you can navigate these markets successfully. Tomorrow, we'll be diving into the altcoin rotation patterns and what the upcoming token unlocks mean for your portfolio. Until then, trade smart, stay safe, and remember, the market rewards patience and punishes impatience. This is Boni, signing off from Boni's Life, where we make crypto make sense one analysis at a time.